Okay, guys, welcome to today's video. We are going to be talking about how I use mitigation blocks to also catch some entries. If you want to really understand what a mitigation block means, you have to go to day 24, where I talked about breaker blocks and mitigation blocks, and I differentiated what a breaker block is and what a mitigation block means. And it's simply like this, right? I said a breaker block is usually for a reversal. When market was bullish, then all of a sudden you want to catch this move to the downside, right? This is a breaker block, usually reversals, while a mitigation block are usually for continuation. It means market is bullish and want to continue going bullish and catch the mitigation right here for the continuation without coming back to a major order block below. The market continues going bullishly, right? So this is the difference between a breaker block and a mitigation block. So I'll be taking you through more examples, just like I said during that day 24. So if you want to really understand it deeply, you need to go back to day 24, where I talked about it. All right, so this is Doge USDT. A typical example of a breaker block happened right here when this market was in a bullish move. Then all of a sudden, remember when we talk about displacement, wherever there is displacement in the market, it means an impulsive move either upside or downside and creates those form of imbalance. We want to pay attention to them. That's where SMC traders we like to pay attention. We don't like to pay attention to rough regions like this, right? Rough regions like this. We pay attention to impulsive, where there are impulsive moves, right? Any area there are impulsive moves, right? That's where we pay attention to. So if you look at this, you have market moving this way. Let me draw the trend right here. From this movement, you have up, you have down, makes another move to the upside, makes a move to the downside, then creates an impulsive move. Then market came back down to the mitigation block, and boom, buys. Your TP will be from the mitigation block to what, the previous high. So it means from this range to this high, which is still similar to internal range liquidity, because there's an imbalance here that pushes the price up to the external range liquidity. So what happened here? The mitigation block is usually the last bullish block. If the scenario is bullish, which is this, market was in an uptrend, then all of a sudden you see a move down, right? So the last bullish block before the downward movement and the break of structure, that's the what, mitigation. So I usually mark it from the body, right? So you see that candle. So this block, let me zoom it out so you guys see very well. So this last green candle here before this bearish move and the impulsive move, that will be my mitigation block, right? So you mark that out so you can see the market wants to continue moving bullish. So you have a beautiful trade from here, right? And you can just put your stop loss below, a little bit below your mitigation block. Then you target higher regions. You target this region right here, liquidity. So you see there's a beautiful 1:4 setup that you can trade off from. So you can see market went all the way to hit TP around this region, and you are done. What market does after does not concern you, right? What market does after does not concern you. You saw the move, an impulsive move to the upside. You targeted what, internal range liquidity for your entry and external range liquidity for your take profit, below the mitigation block for your what, exit, which is stop loss. So you have a beautiful 1:4 trade. So this is how to catch entries, mitigation block. We don't need, you just know that, oh, as the market creates this impulsive movement and is ranging to the lower side, you can catch the market for a continuation to higher regions. And you can also use higher time frame confluences for confirmation. If you want to use higher time frame confluence for confirmation, if market is going to go here, it's very simple. All we just need to do, start from, say, the daily time frame. But I don't want this to be about this video to be about higher time frame confluences. Okay, I really don't want it. So, but I'll just, for your understanding, right, it's good to do that. Let me take this out. These are the lines I drew before. Okay, okay, okay. higher time frame confluences, you saw market moving to this region, so there was a form of what imbalance right here on the higher time frame, right? And of course, you know that market is likely to go and mitigate the midpoint. So if we are to draw the imbalance on this daily time frame, we have the midpoint around somewhere here. Okay, so if you have this at the back of your mind and you are trading on lower time frame, you know that, oh, there's a line here, right, that market may likely to sell from because it's what a higher time frame um, imbalance for a sell side, right? You can see immediately market tap into the higher time frame imbalance. You see that sell, and with the news that came out today, it propelled the movement very, very fast. Okay, but as a smart money trader, whatever setup you have must give you beautiful entry point. You can see the entry is very precise. You can see the exit is also precise, and you make your money 1:4. You are out of the market. Okay, so these one beautiful examples that you want to take note of. It repeats itself over and over, right? We can see another example right here on SUI USDT, right? It happened also here on SUI USDT. Market was also bullish. The same kind of stuff, right? If we go to a higher time frame, say the daily, right? You can see the market also have created this form of imbalance. Remember, when there's a zone and you want to trade, all these zones are just for identification. Not every zone you want to trade off from, right? Has this form right here of imbalance right there. So there is a possibility market will go and take that out, right, before doing it. Look at it very clearly on the 4 hours, right? You can see this imbalance right there on the 4 hours. So there's a possibility that market would go and mitigate the midpoint of that imbalance. Even though it does not change the structure directly, you know that there is going to be a reaction, right? It must not change the structure completely to bearish, whatever. Okay, depending, I don't know, but there will always be a reaction when market comes to those zones. Either it slow the movement down or it change the structure. So having that in mind on higher time frame perspective, and you are seeing this move, then you are seeing market buying from here, and market has been buying, creating this thing, and you know that, oh, there's an imbalance here on higher time frame. So it means you are not, you can catch the buy. It means you are not yet into a sell side, so your trade can be good. So when you see this movement like this now, let me draw that out, right? From here you see the buy, sell, a buy, a sell, impulsive move, right? Right, what are we waiting for? Mitigation block, tap, will take profits at the other side. Beautiful trade, right? You can see this when market creates this side and create an impulsive move to the upside. My interest was the mitigation block, and like I said, I love to use the body for the entry and the wick for the exit, right? So you can see it's a beautiful trade here also. You take your long position right here, right, and you just put your exit just below that mitigation block, right? Then you target the exit liquidity, which is this will give you 1:4. If you want to still be stubborn and greedy, you can even target higher regions, but I'll target this other form right here. Then you can see how markets aggressively just went there after the tap. Beautiful take exit. This is a 1:5. Beautiful trade. So this is how you catch SMC setups very easy. You must actually know what you're doing, and higher time frames perspective also plays that important role, so that you know that, oh, hope I'm not trying to buy close to a sell zone, right? If I'm buying, I want to exit before a sell zone. Then you can see immediately it tapped into that mid-range, markets are selling, and the news also had a beautiful impact to that. So you guys see another beautiful example of it. It happens over and over again, right? Most times when market is buying, you just want to look at what is happening, right? Then you understand what is happening. If you see it, you'll be able to take a beautiful trade move right there, and you know that, oh, market is still following this trend, so it's safe. But you know what a lot of people will do? They will not consider this higher time frame perspective sell zone. They will not take a trade off this mitigation block. The mistake they will do is they will be marking this other block because they do not know what a mitigation block is, and market has mitigated that area. They'll be marking this other block and be waiting for a trade. Then all of a sudden you see markets tapping into higher time frame sell zone, coming back to take them out. right? When they have already missed the move. They've already missed the move. Most times, if market actually buys from a mitigation block like this, right? This other block would not, most times, it would not be very strong, right, to hold this market. So a lot of people will miss this move. They'll mark this zone as inducement. They'll say this is an inducement, and they'll be waiting for market to come and fill. They'll say this is an FVG, right? They'll say this is an FVG. They'll be waiting for market to come and fill it. Then all of a sudden, boom, market will take them out because it has tapped into a higher time frame region. Okay, so these are some of the mistakes you do not want to, you want to be, it is not easy to cite them, but of course you will get there in time or with time, right? So the final example we have here, I took all these trades, mind you. Yeah, I took all these trades. So these are live trades. These are live trades I took. They're not just backdated. These are live trades I took. We have one on gold also, a beautiful mitigation block entry there on gold. The gold one is even very sweet because on higher time frame you get to see those zones very very well, right? So you know that price, right? Market was bearish. Now this is a breaker block example. In fact, this is a beautiful breaker block example, right? Market was bearish, then we had a sell move. Remember when I gave you the example? For example, market was bearish like this, then all of a sudden market disregarded a particular sell side order block. So if market is coming back down, we expect it to tap from this breaker and continue. So this sell order block here would now act as the what, breaker block. Okay, so when market aggressively took out this region, we see an imbalance, and of course, why is here a breaker block? There was a break of structure here. So market is supposed to at least respect this to go to the downside, continue the downtrend. Then all of a sudden there is a big impulsive move. So the last green candle before that move is usually what we tag as the breaker. So if you look at this, market actually, I love using the body, so I'll use the body. Market actually tapped into that range, that breaker, right? And if you're not an aggressive trader, for these kind of trades you would want to wait for confirmation. And what's the confirmation you want to wait? If market tapped into this, right? You know why? Because of this range, of course, this beautiful range also, and market also have a kind of mitigation block also across this region right here. So in this form of trade, aggressive traders may want to take this buy from here, right? You may want to take this buy position from here, but having entering this buy position from here to target upside also, that is also a beautiful trade, right? It's a beautiful trade because you have the breaker, you are tapping into this region and targeting upside for an entry. But another thing you could do is to wait if this region is going to hold. All you want to see is a break of structure or a market structure shift, since the market was bearish. So this was the low, right? So you want to wait for market to shift structure, and we saw a shift in structure here, right? From this region right there, this was the low that gave birth to this region, then market closed bullishly. So now that's a confirmation to go to lower time frame to catch a beautiful trade. Same method you use to cite this shift on what, lower time frame. On higher time frame you want to I've explained that, of course, if you follow my videos. Okay, same point of interest, same way you pick a point of interest, right? The point of interest here is an imbalance and a breaker block. You will see something like that for an entry on lower time frame. Okay, so if you go to 15 minutes, of course 4 hours, you want to head to the 15 minutes. Let's look at what happened right there on the 15 minutes time frame. This is where the market shift happened, right? And just before that market shift, market created several impulsive moves. One here creating an imbalance, one here creating an imbalance, and one here also creating an imbalance. Now if you remember what I told you guys about structural liquidity, that right, you have this move break, right? So this is a good point of interest for me to look at the market and to really catch your trades. If you enter from here, you see make a beautiful trade, right, of this particular imbalance. You can see when market came here, it rejected off this region and still bought to the upside. So 1 2 3, right? So if you are taking a trade off here too, you would have gotten to target the external liquidity, right? It will also be a good trade, but I would be waiting for this one, this particular one that instigated this move in the structure, would be my really good point of interest where I would want to buy from. So if you look at this imbalance here, Let me draw that out very well. Right, you can see here, if you look at when market came to this imbalance, right, and also that particular breaker block, you can see the reaction it had. Right, this was the last candle. Okay, this was the last candle, green candle, before the bearish move, which also corresponds to the feeling of that imbalance right there. So you'd have gotten a more high risk, high reward, risk to reward trade right here. Just put your stop loss just below and target external range liquidity, which is the previous swing high. So this would give you a beautiful 1:5 trade. You can see how, and I think some of my students actually caught this particular move. Whatever market does later does not really matter. If you look at what market did, it actually came back down after taking that high to this other point of interest you have. So if you see, market actually reacted to all the points of interest, right? All this imbalance reacted, it came back down, reacted, and it took our previous high. But this one, when market tap into, we saw a push to the upside. But when the news came out, market decided to go lower. This was exactly around the area of time when the news came out and market pushed to the downside. Okay, but you can see you have also must have also catched a beautiful trade right here. Inducement, liquidity, tapped into that POI, and boom, beautiful 1:5. So these are some of the ways you need to learn how to read the market, right? Always have something you are seeing, and of course, as long as the market has always been repeating that same form of reaction every time, you will get it most of the time. So what have we discussed? You have seen several ways to actually trade off a what mitigation block, right? So whenever you see market moving in that direction, uptrend direction, you want to be able to catch a beautiful trade. So thank you very much, guys, for watching.